Hi everyone, today we'll be solving the COMM 217 2014 question 1, which is the multiple choice section. So we'll start off with question 1. Which of the following accounts would appear in a closing entry? So for a closing entry, you know that you close all your temporary accounts to 0, which is your revenue accounts and your expenses accounts, which will then transfer to your retained earnings. So then for the next year, all your revenues and expenses could accumulate for that next year. So the possible options are A, salaries payable, B, trade accounts receivable, C, retained earnings, and D, accumulated depreciation. So for A, B, and D, these are all accounts that appears on the balance sheet and not in the income statement. So these aren't temporary accounts, they're permanent accounts. So the only solution is retained earnings, and why retained earnings is correct is because all your temporary accounts which are closed are then transferred to retained earnings. So retained earnings does appear in your closing entries. So the answer would be C. For question 2, it says, on June 1st, 2013, Window Inc. signed a note for $10,000 payable in 3 years. Annual interest of 9% is payable on June 1st of each year, beginning in 2014. What amount of interest expense should be reported on Window's statement of earnings for its fiscal year ended December 31st, 2014? So, if we make a timeline, they're asking for the year December 14. So they're actually talking about this period and not the period where they actually received the note. So if you take the 10,000 times the 9% times the full year, which is 12 over 12 months, you get $900. However, if they wanted to ask what the interest expense would be at December 31st, 2013, over here, you would use the 7 over 12 months instead of the 12 over 12, and you would get $525. But since they're asking for the December 31st, 2014 year, then the correct answer would be the $900. And if you go back, A says 900, and that is the answer. And for number 3, it says failure to make an adjusting entry to recognize accrued salaries payable would cause the following. So before we start this question, so let's say, we forgot to accrue the salaries expense, so we forgot to debit the wages expense, and we forgot to credit the wages payable account. So if you forget to record the expense, then your expense is understated because your expenses should be higher. And if you forget to credit your wages payable account by 1,000, your liabilities is also understated because a credit increases your wage payable, so there should be more in account. But your shareholders' equity, it's overstated because your wage expense, you didn't record it, so you have less expenses, which increases your net income. So this causes the shareholders' equity to be overstated because the net income should actually be lower. So that's why the shareholders' equity is overstated. So if we look at the possible solutions, we see A, an understatement of expenses, which is correct, liabilities and shareholders' equity. But since shareholders' equity is actually overstated, A is incorrect. B says an overstatement of shareholders' equity, which is correct, an understatement of both expenses and liabilities. So this should be the correct answer. Let's see what C and D says. C is an overstatement of both assets and shareholders' equity. Well, this is right, but the failure to recognize the accrued salaries payable has no effect on assets. So that's why C is incorrect. And D, an overstatement of both assets and liabilities. Well, it's the same thing as C. The liabilities is correct, but it states assets as well, and it has no effect on the assets. So the correct answer still remains to be B. Question 4 says, Bianca Corp reduced its selling and administration expenses while maintaining sales volume and the sales price of its products. How will this affect the net profit margin ratio? So first, the net profit margin ratio is your net income over sales. So a great way to answer this problem is just by giving a small example. So let's say at the beginning we had a net income of 100 and sales of 200. So that would give a 0.5 profit margin ratio. But it says that its selling and administration expenses was reduced, but the sales still remain the same. So let's say your sales still remain the same, so it's still 200, but your expenses, let's say, went down by 25. So that would increase your net income by 25. So now your new net income is actually 125, and this will give you a 0.62 profit margin ratio. So just by doing a small example, you can see by the reduction of your expenses, your net profit margin ratio is actually increased. So if you look through the answers, you can see that C says the ratio will increase, and that is correct. All right, so number 5 says the dual effect concept can be described as follows. So the dual effect, just before we start, is the dual effect is that there has to be an equal debit and credit. There can't be an unequal debit because that would go against the general accounting equation, which is assets equals liabilities plus shareholders' equity. So let's look at the possible answers. So A is recording a transaction in the accounting system will have at least two effects on the basic accounting equation. So this is correct because it will have two effects on the basic accounting equation. So it will affect the assets or liabilities, or it will just affect the liabilities and shareholders' equity. So let's just go through the other possible solutions as well. B says when an exchange takes place between two parties, both parties must record the transaction. The trick here is that this is actually a true statement, but this doesn't define the dual effect concept. So that is incorrect. C says when a transaction is recorded, both the statement of financial position and the statement of earnings will be affected. This isn't true. Just as a quick example, let's say if you buy inventory, you debit inventory and you credit cash, and this would only affect the statement of financial position and not the statement of earnings. So that is incorrect as well. D says when a transaction is recorded, one account will always increase and one account will always decrease. This is incorrect as well because let's say for accrued salaries payable, you would debit your salaries expense, which would increase your expense, and you're going to credit your salaries payable, which also increases your payable. So that is why D is incorrect and A is correct. So 6 says when using the allowance method, as bad debt expense is recorded. So let's say, for example, I said bad debt expense is 1,000. So you would debit your bad debt expense by 1,000 and credit your AFTA account by 1,000. And I'm just assuming, let's say your accounts receivable is 10,000. Then 1,000 AFTA would reduce your 10,000. That would leave a net accounts receivable as 9,000. So now let's look at the possible solutions. So A states total assets remain the same and shareholders' equity remains the same. This should be incorrect because just for an example here, you see your accounts receivable actually decreases and that's a part of your assets. And for shareholders' equity, you have a bad debt expense. So that actually reduces your net income. So that would actually reduce your shareholders' equity, and that's why A is incorrect. B says total assets decrease and shareholders' equity decreases. Well, as we explained in A, this is just the opposite effect, and that is correct. But let's look at C and D. So C says total assets increase and shareholders' equity decreases. Well, as we explained, the shareholder equity decreases, so that's right. But we also explained how the assets actually decrease because of the AFTA. So total assets increasing is an incorrect statement. So C is incorrect. And D says total liabilities increase and shareholders' equity decreases. So, like again, this is a correct statement, but the bad debt expense debit and the credit of AFTA actually does not affect the liabilities. So liabilities has no play in this journal entry. So that's why D is incorrect and B is the correct statement. For number 7, it says the inventory costing method selected by a company will affect. And for this, you should assume that prices are changing because for the weighted average method, you'll have a different number than the FIFO method. So the statement of financial position. So the reason why this has a different effect on the statement of financial position is because you have two different inventory numbers when using the two methods. So this will change your ending inventory account, which will be on the balance sheet. For B, the statement of earnings will be different because when you have a different inventory account, then when you sell your inventory, your COGS, or cost of goods sold, would also be different. So that's why on your income statement, your cost of goods sold account would have a different number while using the two different methods. And for the statement of retained earnings, this relates to the income statement because your expenses for your cost of goods sold will be different. So when you're going to be closing your entries, you're going to be having a different net income. So that would also cause a different retained earnings account. So A would be correct, B would be correct, and C would be correct. So as a result, all the above would be correct, and the answer would be D. For question 8, it says, which of the following is not a financing activity on the statement of cash flow? So not a financing. And a financing activity is just when a company receives money from debt or pays off debt. So for A, we have lending money to a shareholder. Well, you're not receiving money from debt or paying off debt. You're actually lending money to a shareholder, and that's not even part of your business. So that should be a red flag when you read that. B, borrowing money from a local bank. So you're borrowing money, which is increasing your debt. So that's correct. So that would not be it. Paying dividends to your shareholders. So you're paying dividends to your shareholders as part of your operational business. So it helps you finance your company. So that is correct also. So that's not the answer. And then D, issuing shares to shareholders. So you're also receiving money, which is going to help pay off debt or pay for your assets. So that's also correct. So the answer, like we said, was A, lending money to a shareholder. For question 9, if a company reported the following items on its statement of earnings: cost of sale, $100,000, income tax expense, $40,000, interest expense, $10,000, operating expenses, $70,000, sales revenue, $280,000, what amount would be reported for the subtotal earnings from operations? So earnings from operations is just your revenue minus your cost of sales, which gives you your gross profit, minus your operating expenses. So the best way to solve this problem is to actually do it. So your revenue is $280,000. Your cost of goods sales is $100,000. So if you take your difference to get your gross profit, it'll be $180,000. And then all you do is just subtract your operating expenses, which is $70,000, and you get your earnings from operations, which is $110,000. You don't include your tax expense or your interest expense because that's after your earnings from operations. So your answer is $110,000, and you can see that the answer is D. Question 10 says, Bueno Corp reported gross sales of $500,000, one half which were on sales on account. Customers use their credit cards to pay for $200,000 of the sales. Their credit card company charges 3% for payments made by a credit card. Sales on account for $30,000 were returned to Bueno Corp, and sales discounts of 2% were taken on the net credit sales. What is the amount of net sales? So there's a lot of information in this question, so we'll just solve it step by step. So if we have 500,000 of gross sales, and it says that 200,000 are paid on Visa credit, and it also says that 250,000 is paid on accounts receivable. So the extra 50,000 must be from cash. So if we start off with 500,000 of the gross sales, we know that from the 200,000 we have, as it says, we have a 3% charge. So we owe Visa 3% of the 200,000. So if we subtract the 200,000 times 3%, that gives us 6,000. And then it says sales on account for 30,000 were returned for Bueno Corp. So that means the full 30,000 must be subtracted from the gross sales as well. And then if we keep reading, it says sales discounts of 2% were taken on the net credit sales. So it says 1/2 of the sales were on account, which says right here is the 250, but from the 30,000 returns, we have to discount it to get the actual discount number. So we take the difference of here, it'll be 220,000 times your 2% of the discounts you're given on account, which is 6,600. So we have all these three numbers. And just to make it neater, I'll rewrite it. And before I write the 6,600, I actually made a mistake because 2% of 220 is actually 4,400. So sorry about that. So if you subtract the 4,400 and you sum all these up, you get 459,600. And if we look at our answers, that results in C. So the correct answer is C. Number 11 says, which of the following would normally not be found in the notes to the financial statements? So the notes for the financial statements just explains the numbers in the balance sheet, so like the quantitative data of it. So if we look, A, the accounting rules applied in the company's financial statements. So that would be correct because we're explaining how we got the numbers to the financial statements, so the accounting rules on how we calculate depreciation or how we calculate bad debt expense. So that would be in the notes. B, a description of the company's products and services. Well, there's nothing in the balance sheet that explains, what the company's products are and the services. So that would not be found in the notes. C says additional details supporting numbers reported in the company's financial statements. Well, this is correct because it's supporting the numbers, so the quantitative data that is found in the financial statements. So that's not the answer as well. D says the relevant financial information not presented in the company's financial statements. Well, that's important because relevant, that means there's it's a material amount. So there definitely should be an explanation of the relevant information in the financial statements. So that's also would be on the notes. So to conclude, the answer for 11 is B. For 12, at the end of a recent year, the Gap Inc. reported total assets of $7,564 million, current assets of $4,005 million, total liabilities of $3,177 million, current liabilities of $2,158 million, and shareholders' equity of $4,387 million. So what is the current ratio, and what does this suggest about the company? Well, the current ratio is just your current assets over current liabilities. So a lot of this information is actually not important because all we need to know is the current assets and the current liabilities. So if we just divide these two numbers, we get 1.86. So this rules out A and C. But now to explain what the current ratio is, it's just saying how of $1 of liabilities, how much current assets do you have? So you have 1.86 of current assets for every $1 of current liabilities. So that means you're able to repay your liabilities, so which is sufficient amount of liquidity. So for B, it says that the ratio of 1.86 suggests that the gap has sufficient liquidity, which it does because it's over 1. So B is the answer, where B is not the answer because it's saying the opposite. For 13, which of the following statements are true regarding the statement of financial position? So number 1 says one cannot determine the true fair market value of a company by reviewing its statement of financial position. This is true because in the statement of financial position, it only shows the historical cost and not the fair market value. So 1 is correct. And 2, certain internally generating assets, such as a trademark, are not reported on a company's statement of financial position. That is true because sometimes internally generated assets, like a trademark, cannot be really assessed as like the true value, so it cannot be stated on the financial position. So that's also correct. And 3 says a statement of financial position shows only the ending balances in a summarized format of all statement of financial position accounts in the accounting system as of a particular date. That is also true because when you look at a balance sheet, it only has the one sum of each account. It's not like it's giving you every single account receivable as an example. So this is also true. So all 3 are true, which means that D is the correct answer. So for 14, upon review of the most recent bank statement, you discover that you recently received a not sufficient funds check from a customer. Which of the following describes the actions to be taken when preparing your bank reconciliation? So a not sufficient funds check is, for example, let's say a customer gives you $100 in a check. So you would debit your cash and credit your revenue by 100. But when you go into the bank and actually submit the check to the bank, it bounces. So immediately the bank does not record the non-sufficient funds check, but in your books before going to the bank, you've already debited the cash and credited your revenue, which should actually be disregarded. So as we look in the possible solutions, it says A, balance per books, no change. Well, that's wrong because you should decrease it because the check bounced. And for the bank, if they're saying decrease, that's wrong because they haven't done anything yet. They realize on the spot that it bounced and didn't do anything at all. So B, decrease, and increase should also be incorrect, even though that this is right, that the balance per books should be decreased. The increase is wrong because there should be no change. So that is why C is the answer, because it's decreasing the books and the bank is not doing anything at all, and that's why D is also incorrect. So the final solution is C.